I'm Michael Fox, and this is the Prospector Podcast. And I have joining me returning guest Mike McGlone, the Chief Commodity Strategist for Bloomberg Intelligence. Welcome, Mike.
Thank you, Michael, for having me back on. And I sure hope I can give you early congratulations for a potential Blue Jays victory in the World Series. I would love to see them win.
Yeah, it'd be nice. I remember when I was a lot younger, the first time that they'd won it. I'm a closeted Red Sox fan right at the moment. But it'd be nice to keep it in Canada for sure.
That's the whole reason. I just want to see Canada win this one, and just want to stick it a little bit to the Mr. Trump. But go ahead. Let's go. Let's talk about markets.
Let's talk about markets. All of a sudden, and we are recording this on Halloween Day, the markets for commodities got pretty scary here in the last couple of weeks. So I thought it would be a good time to get you on to clarify ourselves out and clean it all up. But before we get into the individual commodities and stuff, I've been positing a new thought, and I wanted to talk to you about it because it seems rational to me, but maybe I'm nuts. But I'm watching a lot of these commodities, like in the case of gold and silver, hit new highs. I'm watching platinum, palladium, copper remain elevated in price when there should be lots of headwinds that are preventing that. And I've been searching for a reason why, and I've kind of landed on this as a thought, but let me ask you about it. My thought is that a lot of these elevated prices are a reflection of weakness in the US dollar, but in typical fashion, that would show up in the US dollar index. But because all the currencies themselves are kind of weak at the same time, it's not necessarily being reflected there, and the reflection of a weak US dollar is actually showing up in the commodities markets. Now, you're my commodities and US dollars expert. How out to lunch am I?
I think you're spot on. The Bloomberg Dollar Spot Index is down about 7% this year. The broad dollar index is down about 6%. And Bloomberg Commodity Index, broad index, is up about 14%. Now that makes sense. It makes sense. But then you look over at the S&P 500, it's up about 18%. And the main driver for commodities are metals, being led by gold. And I like to use the word, particularly because we're recording on Halloween Day, this is just absolutely frightening what's happening in commodities, with gold making a parabolic move up 52% in the year as we speak, and crude oil down 15%. I mean, we're talking about the world's ancient store value that no one cared about a few years ago. And it's just I think it's getting its revenge against things like the stock market, and virtually every asset's underperforming this ancient store value. And then this most significant industrial commodity on the planet down 15%. In the year with, that's down about the same year the stock market's up. What happens to me when we do have a little bit of back and fill in the stock market? Well, say if we end the year up 10%, which would be the average since 2000, that's a pretty severe global deflationary force showing. With, gold's never been up this much, with crude oil down this much. This disparity is about 60, almost 70% since 2008. And that disparity on an annual basis was 60%. So this is very frightening stuff happening in the markets. And the bottom line, I think I see from, as you mentioned, is picking up is Dow weakness is mainly because the U.S. stock market's backed off versus the rest of the world, like the MSCI ex-US index. But I look at this as if we can just, to me, this increases my concern that we have an absolute inordinate burden on a global basis for that U.S. stock market to stay resilient, or we're going to potentially get some normal deflation from the inflation. I've just never seen it so important. So the way I want to end it is I've never seen a time in my life where you cannot make a prediction. It's very difficult to make an appropriate prediction about any market, anything, GDP, economy, consumer spending, anything, without a view in the U.S. stock market. The example is we're up, 10 trillion this year. 20, it's almost 20%. That's 40% of GDP. So just imagine if it drops a little bit. That's, 20%, 40% of GDP. That's the most in 100 years. So that's all that matters now. And I think gold's figuring it out. And that's why it's all that matters now. Unfortunately, from a proper strategist standpoint, is if you want to be saying, I was on a call the other day and a bunch of people were bullish crude oil. I'm like, okay, so you're bullish the stock market. And they asked me, what are you talking about? I'm like, yeah, if the stock market drops 10%, that's a severe deflationary force. Crude oil is going to drop 20%. Probably. We'll see.
Yeah, yeah, it is apropos that we're doing this on Halloween because, yeah, I'm seeing lots of scary things out there as well that cause me, a great amount of concern. But let's take a look at the commodities. Like gold hit all-time highs, silver hit
Yeah.
all-time highs, and they did this parabolically. Like they took off back
Yeah.
in March like a scalded cat. Like when you and I talked, we were talking about the possibility of $4,000 gold, but we were talking first quarter in 2026 for that to happen. We were all, anybody else was saying second quarter of 2026. And here we were going into the last quarter. We not only hit 4,000, we blew through it. And now we started to see a bit of a correction. And as I laugh, if I told people when I started this 20 years ago, gold would be over $4,000 and people would be lighting their hair on fire, they would have looked at me strangely.
Mhm.
But here we are. We're in a correction right now. But the correction seems to be fighting itself. Like, what's going on? Like it's up
I,
one day, down the next, and
we're in the as far as the stretching here, this is a pretty extreme market for gold. Now, I've been a bullish gold. I think a lot of people have been for way too long. And I have to remind our viewers and listeners that I was bullish gold when it first, to stay above 2000 and first reached there in 2020 and 2021, and then Russia's invasion in Ukraine in 2022, and then 2023. So just to remind myself and our patient listeners that I had to get beat up by this market forever, being the bullish strategist and feeling like an idiot. Then finally it breaks out. The bottom line is just the simplistically, I've been fundamentally, technically bullish gold, but other times, sometimes you have to put on your risk management hat. And this is just not a place to be looking for overweight gold positions to perform well if history is a guide. Now, I can go back, gold obviously can go back thousands of years, but realistically, since we came off the US gold standard in 1971, the only time in history we've been this stretched against a 40, 50, 60 month, 200 day, 200 week, most moving averages, most people would say it's a third to fourth standard deviation, was near major peaks in the late 80s and the major peak in 2011. You just have to be very careful. So I think it's telling us something, but it's not going to be different this time. You have to be very careful. I'm not going to go out and say we're going to go up 5,000 in gold right away. Like before, I felt pretty confident about 4,000. From these levels, history tells us we can easily correct 1/3, which means we're getting close to 3,000. It could easily happen. That's just how it happened. And it could be within a bull market, but that's what's happening. We're a stretched bull market. The key thing that matters to me, for me, Michael, is what it means for everything. Now, for those of us who've been way overweight bullish gold forever, this is a time you're supposed to do the prudent thing in life typically and do the thing that's the essence of the business is sometimes it's okay to take profits. And personally, now we're in that pile-on stage. Now it's happening in ETFs. There's a major pile-on. 4 years of outflows have switched to inflows. We get that. But I switch over to now is I don't really care about the reasons. And that's why I switch off that part of my outlook and switch over to just what it means, how stretched it is. It's very stretched. Now, what it means is what really scares me. And that is you mentioned silver, platinum, palladium, even copper. All the metals, most notably precious, are going up on the back of gold. And now they got a little bit of stretch. Silver, finally made a new high. Now it's probably, it's around $48 an ounce. It probably hovered there for a while. Could easily drop to 40, maybe 45, and still be a bull market. Those of us traded silver for a long time know how that happens. Now, it needs to spend some time above 50, I think, for me to start getting more bullish silver. But the bottom line is also, let's look at that silver-gold ratio. Right now, it's about 82. It recently bottomed around 79. And 80 has been key support forever. That's more likely to go up, I think, particularly if the U.S. stock market wavers a little bit and we see some uptick in volatility, which is have been absent the stock market for, on a 90-day basis. That's the lowest volatility in almost 5 years. So overall, I say gold is just a stretch bull market. Be very careful. Typically, performance is poor from these levels. Now, if we can do what we did back from that March peak and do a time correction, remember we did that 5 months in a row. We just hovered above 3,000. 3,500 was the high, and then we broke out. If we can do something like that, that would be a nice stair-step rally. I don't know what's going to happen, but the bottom line for me, the next key catalyst for gold is I'm really worried as we head towards this final months of the year that we just get a little backup in the U.S. stock market. This huge rally in gold and big plunge in crude oil will make more sense historically. But I'll end with this. If you had told me at the end of last year that this time you'd only told me two things, that gold was up 52% and crude oil was down 15%, I'm saying, yeah, okay, that sounds like a global recession. U.S. stock market's down 20%, but it's the opposite. U.S. stock market's up 20%. That's where I'm just trying to figure out. But there's certain times in my life as a strategist, I say you're supposed to just kind of get out and just stick with treasuries and simple things that don't lose money, and I feel like that's it. For instance, the last number of years, I was really bullish. Bitcoin got off that horse too early, but it's really showing signs of a peak bull market, and we've been really bullish gold for too long, and I feel myself saying you're supposed to just back off.
Okay, you've talked about two distinct possibilities. One, that the gold market goes into a proper correction, and then the other where you suggested it was a stair-step correction like we had back in March. Which way you're leaning, and what would be an indicator of one versus the other?
I'm leaning towards the latter, a stair step, and I think the key indicator would be what the stock market does. Now, unfortunately, now, as I mentioned earlier, and by the time this hits tape, I'll be publishing, it's as a strategist, it's just, and any major person in the planet making any decisions about markets, I don't think you can do that now without a proper view on the U.S. stock market. Now, I'll say, if the U.S. stock market stays resilient, gold will probably have some issues. If the U.S. stock market backs up, if it does it rapidly, now it might be a little bit like 2008. Gold will suffer initially, but to me, this is what gold is predicting. It's signaling that the U.S. stock market is just way too elevated. Seek alternatives, and there should be other ways to express and invest. And the ancient store value, I think, is more likely to time correct, but it's easily can drop 3,500, and that's just the old highs.
Yeah, let's put a tip to the hat to silver here for a second. Up until recently, $50, just slightly above that, had been the high water part for silver. It kind of touched it, and just like hitting the third rail, it shot the silver price back down, and we went a little bit over, but it seems to be the same type of scenario. So I'm wondering, in spite of what you said about gold, is silver going to continue to, mimic gold as it moves up and down through this correction, or is there still that third rail? It's got to bump up against that a few more times before it breaks through.
I think it's a former. Silver, platinum, palladium, almost all the metals are going up on the back of gold. Central banks are buying gold. Silver is an industrial metal, more so every day. It's more tied to copper, and maybe some of the PGMs, platinum and palladium. But so, I mean, for silver to go higher, basically is dependent on gold. And I fully expect that silver to gold ratio to continue to advance. And it has been, and most notably if the U.S. stock market declines. But that's the key thing to remember about silver. It's in this environment, particularly as the whole world faces unprecedented tariffs from the U.S., yes, there's major industrial demand for silver picking up, but it's more of an industrial metal like copper now than it used to be. So it needs that factor, and that's why I point out if you want silver to outperform gold, the number one prerequisite, I think, is the stock market has to go up. And the fact that it's still underperforming gold, the stock market going up, is showing that divergent weakness. We're seeing things like crude oil. Crude oil down about 15% in the year that the beta is up. Total return S&P 500, 17%. It's a really bad sign. Just imagine if we get a little backup in the stock market. That's what that market's telling you, that it's showing divergent weakness, I think. So for silver to outperform gold, I think you need the stock market to keep outperforming and global demand pull to pick up. And that's probably early days for that. I still see things like China, major reversion in that entire country. And just look at here, let's talk about one final thing for deflationary forces in China. Its 10-year note yields 1.8% versus about 4% in the U.S.
Yeah, that's one of the things I think is keeping the US dollar as high as it is, that the
Yeah.
interest rates in a lot of these other industrialized countries are a lot lower than the US rate is, and it's keeping the US dollar, inflated to some degree. But again, we take a look at gold. Gold's telling us something. The Fed just lowered interest rates again by a quarter percentage. They're telling us there's weakness in the economy. Oil's telling us there's weakness in the economy. Yet platinum, palladium, and silver and copper are suggesting something completely different. So, do we need to see the stock market have this big correction before they kind of go, "Oh, we have weakness in the economy," or are they going to catch on before the stock market?
Well, that's the problem now. The stock market is the economy. There's only two times in history of anything near this type of stretched valuations. Let's just use the U.S. stock market versus GDP. They make it on a global basis, the S&P 500 versus the MSCI ex-US index. You have to go back, I mean, you can't go back 100 years MSCI ex-US, but at least a century to how expensive we are. So the U.S. stock market is the economy. The next recession, I think, will be driven by the U.S. stock market having its normal correction, like we did in 1929 in the US, in 1989 in Japan, in 2001-2 in the US, stock market went down. It was part of that recession because it just was a reverse wealth effect. I say that with confidence because it's probably the most extreme ever. So to me, that's the first thing to point out. And then I look over at things like copper. The number one reason copper's up this year is, you could say, because of wrong reasons, because of supply constraints. Some of the mining issues and issues with mining in Indonesia. So the key thing to overlay with copper historically is bond yields in China, iron ore, and crude oil, and they're all going down. So that's my problem with copper. Is I see it right now about $5 a pound. It keeps trying to get towards 6. It got there this year so far recently, and we just recently made high in cash copper trade in London around $11,000 a ton. And to me, the risk is U.S. copper is much more likely to go to 4 than stay above 6. And there's one simple thing that might happen: that just a little backup in the stock market. Like I said, if we end up 10% on this year, that will be horrible for people who are long now, but it'll be normal. It'll be the average for the last, since 2000. That's 25 years. That's how things are only matter now, I think, is if you're making any decisions now, if you're bullish copper, you got to be bullish U.S. stock market. If you're bullish crude oil, you got to be bullish the stock market. That's just the way I look at my value at risk model if I'm your risk manager.
So let's take a look at the U.S. stock market then. It hit 48,000 this week. Trying to recall, I think that was the first time it touched 48,000, or if it's not, it's like the second time.
You mean 68,000, the S&P 500?
No, I'm talking about the Dow.
Oh, the Dow.
48,000.
Okay, got it. Yeah,
Yeah.
got it. Sorry,
So
6800.
uh,
Yeah, got it.
yeah, so the stock market remains elevated, and yet there's all these headwinds. And to me, this is looking increasingly more like a speculative bubble that's a super in danger of bursting. I haven't ridden any taxi cabs lately, but I suspect, and the drivers are talking an awful lot about stock tips right now,
What
which should be a warning sign.
I think it's one of the most known knowns in market. What I said about, it's all that matters is the stock market. And I think everybody gets it. And it's just how it plays out, what we do, and how you manage it. And that's why I find it was nice enough to be lucky enough to be bullish gold at the beginning of this year. Because anybody long gold this year has beaten everybody in a much lower risk adjusted basis. Even things like cryptocurrencies are all knocking down and showing major signs of peak bullish activity. Bull markets end in euphoria, pile-on, and massive hubris. And you're definitely seeing that in cryptocurrencies. They lead everything. So I think the tip of the iceberg is cryptocurrencies, and Bitcoin being up the same amount as the S&P 500 this year. Actually, it's only 16% with the S&P 500, 17%. Is showing signs of cracks in the bull market. But then I look over at the broader Bloomberg Galaxy Crypto Index. It's basically flat on the year. It's up almost like 3%. So those things have been leading the bull market. Massive speculation in cryptocurrencies are dying. And then I look at the tip of the iceberg, and that's Strategy Inc., MicroStrategy. It's 200-day moving average has rolled over. It's heading downward. And in normal correction in that stock, since it really got involved in Bitcoin, is 75%. So maybe we're just getting started. To me, all the cracks in the armor are there. And then there's other things like, okay, so we have the Fed did start easing, but they had to curtail a little bit. And I think Chairman Powell finally came out and said the prudent right thing Fed governors are supposed to say is, yeah, sorry, but there's a major party going on with speculative excesses and risk assets, and that's actually when we're supposed to be taking away the punch bowl. He kind of hinted at that with what we'd call a hawkish ease, but to me, we're going to look back at that and say, yeah, you're right. But, he's getting a lot of pressure politically and everything and see unemployment. But to me, this is part of the lose-lose now. And I think gold's signaling that. And I call it a lose-lose because gold's gone up so much from these levels that if in normal correction is 30%. If it continues higher, it's already showing you frightening things with all other risk assets. It means every risk asset's underperforming this asset. As the stock market stays strong and volatility stays low, well, that might pressure gold. But I from these levels, I just look at sometimes you're supposed to just sell or take profits and lock up and wait out in U.S. Treasury. So here's another thing I've been pointing out is on the year, we have the stock market creating another 20, like 17%, about $10 trillion of wealth creation, massive that. Unemployment is somewhat declining, but inflation numbers are ticking up a little bit. But despite that, bond yields and the bond market is starting to show signs of strength. So, for instance, the Bloomberg U.S. Treasury 20-plus year total return index, that's its U.S. Treasury bond, it's up 7% this year. So to me, those are markets waiting to break out. And all it needs is a little drop in the stock market, and bond yields are ready to drop. Crude oil is ready to drop more. And things like copper will just go back to 4 rather than 5. And even silver will probably suffer. And then their gold might probably do okay. But that's when gold, I think, is going to say, yeah, I kind of told you so.
Okay. So you keep talking about the stock market, and you kind of said drop a little bit. We're overdue for a correction in the stock market, and we're well overdue for a bear market. Except with the exception of COVID, which was kind of an anomaly to all of this, we haven't had a bear market in the stock market since like 2008. Is the fact that we're overdue for these things make them more likely?
Well, it's, the whole quote from, the old quote about irrational remaining insolvent, but that usually means in the market going down or if you're short in a bull market. But that's the key thing. We all know we're overdue for a bear market. We've only had 2 down years since 2008 in S&P 500 on total return, and we're overdue for maybe a elongated period, 5, 10, maybe 20 years without record highs, and maybe just a normal correction. I've been saying it's just trying to tweak what I think is rational is we've had 2 50% drawdowns in the S&P 500, both starting right after the Fed started easing and since 2000. Why not another one? And I'm just looking for signals for that. And so far, just by being able to say that gold's up 50% this year and crude oil's down, well, that's a pretty solid signal something's wrong. But, stock market's the last to know. And that's where I'm quite concerned and just have to be careful and nimble. But, some people are saying, yeah, you've been saying that forever. I don't disagree with that. But I also was able in the past to find out much better ways to express, investments that go up in cryptos. And I got, kind of viewed that was getting expensive in things like Bitcoin. And then gold beating everything. But now that's getting expensive. So here's the thing I want to end with. I'm very concerned that over time, if you look at the S&P 500 total return, it always beats gold on a 100-year basis. You go back since, that's even when it was the gold standard. But that stopped happening in 1997. Flatline from if you take that ratio, total return S&P 500 divided by gold, it's the same level right now as 1997. That's a serious sign that something's wrong because you look on CNBC and Bloomberg and CNN and all these stations, they don't talk about gold that much, but they talk about stocks all the time. To me, that's where I'm really concerned. And that's where I tilt over to alternatives and things that are safer. And sometimes it's better just to kind of hide.
Well, it's a good time to go into hiding with all the monsters and creatures that are going to be wandering the earth tonight. So let's suggest maybe we take a look at doing the same thing in the markets. Mike, if people want to continue to follow this, and I think they really should, because like you, this could be one of those things that kind of, I think, might turn on a dime one day, and people need to be prepared for it. How would they follow your work, Mike?
Yeah, that's the key thing. This kind of thing will probably change in one day. And sometimes that's how it happens, and then it just continues from there. So, first of all, on your show, thank you very much. On the Bloomberg terminal, I'm on X at Mike McGlone 11, on LinkedIn, Mike McGlone, Senior Commodity Strategist at Bloomberg. And I'm happy if people reach out to me with an email. I'm happy to add them to my distribution list. And thank you, Michael, for having me on your program. I always like to rehash things that we're talking about now the next time we speak.
Absolutely, Mike. And I'm sure between now and the end of the year, hopefully we will have maybe a less scary environment, or maybe it could be, this podcast could have been pretty pathetic, and, we're going to deal with the aftermath of it. But I'm sure I'm going to have you on again. So thank you very much for your time.
Thank you.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.